Welcome to the Wealth Setting Podcast. This is episode 494. Today is September 28th, 2025. I'm your host, John Pagliano. I'm also the founder and money manager at investablewealth.com. Hey, I've been absent from the microphone here lately because I'm fighting off a cold and trying to preserve my voice with laryngitis kicking in. I did want to get an episode out today, though, because I wanted to comment on the blog post notice that I put out this past week where I fully sold and closed out my position in Disney. That's what I want to talk about today, but even more broadly than that, we're going to talk about business cycles within individual stocks and the stock market. So as far as Disney, I totally sold out my position, and this is good and bad news. You're going to hear this throughout today's episode. You see, because even though I sold Disney, I'm not totally negative on the company. I'm just locking in solid profits that I've made over the last year. And because of recent stock market price action that we've seen from Disney, I just don't want to risk those profits. I see Disney right now going through a potential negative cycle within its normal business cycle. This happens to individual stocks as well as to the general stock market. And as an individual investor, it's critical that you're able to identify these cycles so you don't have to end up holding and sitting through a long drought period in the stock price. It's also important that you ignore the headlines. The reason I sold this past week had little to nothing to do with what you're probably thinking or reading in the headlines about Disney right now. In fact, I waited to sell until one of their major issues with the so-called comedian Jimmy Kimmel had been a settled issue. And I used that slight bounce in the stock price off its lows from the previous week to exit my position. I point this out because I'm not selling because of what's currently in the news, but I'm selling because I think Disney has broken an uptrend pattern that it's been in. And take a look at that post that I put over at investablewealth.com last week. There's a 10-year chart of Disney stock performance. It's been abysmal. That's the bad news about Disney. If you have held Disney over the last 10 years, you've pretty much either not made money or lost money. I believe that's the case because Disney suffers from extremely bad management, if not downright criminal management, people that come in and loot the company. That's the bad news. That's what everybody focuses on. That's how people get discouraged with trying to build wealth and invest in the stock market because they think the game is rigged. But I'm here to tell you there's good news in all this because, over this last decade or more, I've traded in and out of Disney multiple times, and I really don't think I've ever lost money on Disney overall in an individual trade, even though the company really hasn't made any money in a decade. How have I done that? Well, I didn't buy and hold. I swing traded. I used to talk about swing trading a lot more in the early days of this podcast. I got away from it. Well, I didn't get away from swing trading. I got away from using the term swing trading, because it tended to attract a lot of people trying to jump in and out of the market and make a quick buck. That's never the way I've looked at swing trading. I've never been a day trader or even a weekly trader. I swing trade, but I tend to hold my positions, depending upon market conditions, anywhere from, 3 months to 3 years. I'm not about quickly getting in and out of things because I think that's where the hyped pump and dump money is tried to be made, and usually people lose. If you select a good company, an overall good company, where you have a pattern and a history that you can follow, you can look at these trends and try and determine these business cycles, and it's not infallible. It's certainly not down to specific market timing, because there's been plenty of times when I've bought something I thought was going to move up or was moving down and I thought had bottomed, and it continued to keep going lower. But if you have the quality purchase over time, the price goes up. Again, that could be 3 months, it could be 3 years. That's, again, while I have a diversified portfolio, I'm not going to digress and get into all that right now. Let's focus a little bit broader and move out specifically from Disney and their current problems. And let's talk about this business cycle overall. You see, it generally applies to almost every big blue chip, quality type company at one time or multiple times over their life cycle. They go through periods where they have very bad management. Again, bad management, I'm being charitable here. In a lot of cases, these companies are run by downright crooks. And this isn't specific to Wall Street. I mean, why did Jesse James say he robbed banks? That's where the money is. So psychopaths and criminals and bad characters, people that are seeking money and power, they're going to go where that is. That's why they're overrepresented in places like big organizations, whether they be the government or Wall Street. That's where the money and power is, and bad guys are going to try and get a piece of it. Looking beyond Disney or anybody that's in the headlines right now, I think the classic example is General Electric. Now, a lot of you are too young to remember this, but General Electric used to be a powerhouse, like General Motors, right? You know, what's good for General Electric or for General Motors is good for America. The legendary CEO of General Electric, GE, was a guy named Jack Welch. And when I say legendary, I mean legendary. I mean, this guy had rock star celebrity status. There were Harvard business case studies about his management techniques. You know, there were entire MBA programs that were based on his management style. There were literally, thousands, tens of thousands of books and consultants that all talked about the GE way and the way Jack Welch did things. He was literally named as the manager of the century. That's the kind of prestige this guy had. But you know what? After he was gone, it didn't take too long for GE to start falling apart. Yeah, listen, there's no doubt Jack Welch had a good decade or so run at GE with another 5 or more years of where the momentum carried it forward long after it should have. But the balance sheet engineering of his profits, which were built on a very flim-flam, phony foundation, they didn't take long for cracks to materialize. And within a decade or so of him leaving, the company was totally in shambles, in a death spiral. The only reason it really survived is, in fact, it didn't survive. The way it survived was being broken up into 3 separate companies. Now, some would argue that it wasn't Welch's fault, that the company wasn't competitive and yada, yada, yada. I would totally argue that it was all his fault. As my grandfather used to say, Italian grandfather used to say, a fish rots from the head. You know, the corruption starts at the top, and the phony financing and the moving around of assets and the balance sheet engineering, it wasn't a direct Bernie Madoff Ponzi scheme, but it was downright criminal. And again, I would argue that because look at those 3 spin-off companies today. They're pretty much, for the most part, doing extraordinary. But they only shine when they're run by good, solid, honest management. Not with crooks that are trying to look good short-term, make a bunch of money, loot the company, and leave. Unfortunately, we see a lot of that on Wall Street. Again, it's not because Wall Street's corrupt. It's not because capitalism doesn't work. It's because we don't have good enough systems to prevent crooks from getting in and looting these companies. I digress. My point is that I think Disney, for at least the last decade, if not 15 years, is going through that same Jack Welch meltdown, and that's because they've had consistently bad management, and I'd put most of this blame in the modern era on Bob Iger. And again, not just picking on Iger or Disney. Look through the history books. You see the similar pattern. Look at Starbucks with Howard Schultz, how he's come back and forth, making the company worse each time. And beyond that, CEOs that you wouldn't remember because they're not as flamboyant, but here's the companies, just off the top of my head. Boeing, Intel, Target, Anheuser-Busch. Remember the Volkswagen diesel scandal? They've never recovered from that, along with all their other horrible mismanagements. And Nissan and, of course, General Motors. Going farther back in history, JCPenney's, Hewlett-Packard. It's a consistent pattern on Wall Street. But if you learn to recognize the pattern, you can do your best to not only avoid it, but to profit from it. Again, take a look at that blog post over at investablewealth.com. Pull up that chart of Disney and look at its horrible performance over the last 10 years. What do you notice? It doesn't consistently stay down. It goes down, it comes up, it goes down, it comes up. With a company like that, don't buy and hold it, but look for opportunities to come in on a dip. Because generally, companies like Disney, these big blue chip companies, the reason they can survive with such bad management, if not criminal management, is because overall they're an incredible franchise. They spin off cash like a printing machine. Again, this is why they attract the crooks. And so these companies rarely go fully bankrupt, and generally, to the extent that happens, it's a slow burn. It's not going to happen overnight. So if you watch yourself, you can get in and out of these companies. Again, the reason I sold this past week was to preserve a gain that's in excess of like 20%. Based on Disney's current price volume action, I'm worried that it's broken its upward trend and momentum, and while they could skyrocket and go higher tomorrow, I don't want to take that chance. I'm taking my money and running. Now, that doesn't mean I'm going to never buy Disney again. In fact, I'd like to see their troubles continue. I'd like to see the stock price drop below $100, and I'd like to see Bob Iger get fired. And then I'd probably come back in and buy it again. So buying the dip can and does work if you're dealing with an overall good quality company that has the opportunity to recover. The important thing here is to be patient. Look for the opportunity, but don't assume you're going to make money in the next 2 or 3 months. Maybe you do have to wait a year or longer, maybe 3 years. Also, don't get greedy. When I go into companies like this, I make my projections on how I think it's feasible to get a 25% gain, but I'm also realistic and I'm not greedy. I'm going to diversify because I don't want to put all my eggs in one basket because that one company I think is going to hit a home run and go up 30%. Well, maybe it's not going to. So I want to own a broad range of these companies, and some of them do go to the moon, but I'm okay with just taking a 15 or maybe as high as a 30% profit margin, especially if you're holding that, over a year. That's a fantastic rate of return for a fairly low risk investment because, again, you're investing in a good quality company that just happens to have some bad management. Bad management doesn't last forever. They either get fired or they go to jail or they retire. That's the CEO business cycle. Learn to identify it. Again, be patient, don't be greedy. On that chart of Disney, I mapped out the last round of trading I had in there. I think I bought it sometime last summer and just sold it last week. So you can see my entry point and my exit point. You know what? I didn't buy it exactly at the bottom. I didn't sell it exactly at the top. I rarely ever do. But there's plenty of money to be made in the middle. And especially if your time horizon is, say, 6 to 18 months. Be patient, don't be greedy. I can't say that enough. Listen, my voice is running out here. There's more I want to say, but I got to cut it short. Here's the bottom line. I think Disney's problems are much deeper than just what you're reading in the headlines right now. I allude to that in the blog post. I think it's very likely that the Ellison money is going to come in here, and much like Ted Turner disrupted broadcast TV back in the 70s and 80s, he was an outsider that came in with different ideas, and they all laughed at him. ABC, CBS, NBC, they laughed at him, but it ended up that Ted Turner ate their lunch. Disney has already been getting its lunch eaten by the likes of streaming and specifically Netflix. Disney could be fighting a war on 2 fronts, and I don't think Iger's up to that. So I do think Iger's going to lose and he's going to get fired. Well, maybe he'll retire, but effectively they're going to kick him out. Bottom line, business cycles occur on individual stocks, usually because of bad management. They also happen within industrial categories of companies. Specifically, we're seeing that right now with the chemical industry. It can happen more broadly, where it's not just industries, but it's entire sectors of the economy. We saw that with, following the financial crisis. It's been 15 years or so. The whole banking sector looks like it's just coming out of the slump from 2008. And of course, during a recession or a bear market, we see the business cycle not only affect individual stocks or sectors or industries, but the entire stock market. If you learn to identify these different types of cycles, you can navigate your way to long-term profits. Well, hey, thanks for listening today. Until next time, this is John Pugliano wishing you the very best returns.